Hello and welcome back to the Financial Freedom Show. If you're new here, please be sure to hit the like button and subscribe in order to stay up to date with the latest videos I post on the channel. And feel free to comment down below if you're adding SCHD to your portfolio or if you're buying any of the other ETFs that I mentioned. In today's video, I'm going to be explaining why I added SCHD to my portfolio. So without further ado, let's get into the video. So as an investor who's always been looking for smart, steady ways to build wealth, I recently made the decision to add SCHD, or the Schwab US Dividend Equity ETF, to my portfolio. While I'm not against growth stocks or speculative plays, I've come to appreciate the reliability and power of dividend income, especially in today's market where volatility is the norm, and consistent cash flow is more valuable than ever. Here's why I added SCHD to my portfolio and why I think it's a smart move for long-term income-focused investors like myself. The first reason is it provides dividend income you can count on. One of the many compelling reasons I added SCHD to my portfolio is the dividend yield. At the time of my purchase, SCHD was offering a yield of about 3.9 to 4%, and that's just the start. The yield is higher than most savings accounts and CDs, and unlike fixed income products, SCHD offers the potential for capital appreciation over time. Dividend growth is a thing, and your dividends can grow in the long term. SCHD pays quarterly dividends, meaning that I'll receive income 4 times a year. For someone who's building towards financial independence and wants to eventually live off passive income, this is a key part of my strategy. The second reason is it invests in high quality companies. SCHD isn't just any dividend ETF, it focuses on quality. The fund screens companies based on strong fundamentals like return on equity, consistent dividend payouts, and strong, solid balance sheets. This means that I'm not just chasing yield, I'm investing in financially sound, well-established companies that have a history of rewarding their shareholders over time. Some of the strongest holdings in SCHD include Pepsi, Coca-Cola, Merck, and Texas Instruments. These are the kinds of companies that have weathered multiple market cycles and still come out strong, exactly the type of stability that I want in my dividend portfolio. The third reason is it's built for long-term wealth. I didn't just buy SCHD for short-term gains. I plan on holding this until retirement. This ETF is built for long-term investors. The fund has historically shown strong total returns, combining both dividends and price appreciation, while maintaining lower volatility than the broader market. What I like most is that I can reinvest the dividends, compounding my returns over time. The snowball effect, where dividends buy more shares, which produce more dividends, can incredibly be powerful over years and decades into the future. The fourth reason is diversification with simplicity. Instead of trying to handpick 20 or 30 dividend stocks, I get broad exposure to around 100 high-quality US companies, all in one ETF. SCHD takes the guesswork out of individual stock selection while still aligning with my income goals. It's also a low-cost ETF with an expense ratio of just 0.06%, which means that more of my money is working for me and not going towards fees. I added SCHD to my portfolio to create a stronger foundation for income, boost my total returns, and gain peace of mind knowing that I'm investing in a reliable, time-tested ETF. If you're like me, looking to grow your portfolio with stability, consistency, and passive income, SCHD is worth a serious look. It's not flashy and it's not risky, but it works over the long haul, and that's what I care about most. After adding SCHD to my portfolio for dependable income, I took a step back and reevaluated my overall investing strategy in this portfolio. I realized that I didn't just want income, I wanted a balance. I wanted a portfolio that gives me a healthy mix of growth, stability, and income. That's why I've decided to build my core portfolio using the 3 ETFs, VUG, SPLG, and SCHD, with a target allocation of 50% towards VUG ETF, 30% towards SPLG ETF, and 20% towards SCHD. Here's my thinking behind this mix of ETFs. The first is 50% in VUG, and that's for growth in the long run. At the core of my holding strategy is VUG, or the Vanguard Growth ETF. It gives me exposure to some of the fastest growing companies in the US, including household names like Apple, Microsoft, Nvidia, and Amazon. By allocating half my portfolio to VUG, I'm betting on innovation, disruption, and long-term capital appreciation. Yes, growth stocks can be more volatile in the short term, but over time they've delivered strong returns. I'm still young enough to handle the ups and downs, and I want my portfolio to reflect that. VUG helps me stay exposed to where the market economy is headed, not just where it's been in the past. My next holding is 30% SPLG for broader market stability. Next, I'm putting about 30% of my portfolio into SPLG, or the SPDR Portfolio S&P 500 ETF. This gives me broad exposure to the entire US large cap market in a low cost, efficient way. Think of SPLG as my anchor. It's got steady, reliable dividends as a foundation of the portfolio. While VUG focuses on growth and SCHD on dividends, SPLG captures everything in between. It holds companies across all different sectors and includes a mix of both growth and value. That makes it a great diversifier and helps reduce the overall risk of my portfolio. With an ultra-low expense ratio of just 0.02%, SPLG is one of the most cost-effective ways to stay invested in the overall market. It's boring in the best way, and every solid portfolio needs something boring and dependable. The last holding in my portfolio is SCHD at 20% of my portfolio, and I have that for reliable dividend income. I've carved out 20% of my portfolio for SCHD. As I shared in the first part of the video, SCHD gives me a quarterly dividend income from high quality US companies. It's not just about the yield, it's also about getting paid while I wait and having a layer of stability during market downturns. SCHD helps me smooth out volatility from my growth holdings and adds a predictable cash flow component that I can reinvest for compounding returns. In time, I might even be able to live off the dividend income as a part of my retirement plan. Here's what I love about this 50-30-20 split. I love the growth potential from VUG and still having the broad exposure of SPLG with passive income from SCHD. This setup gives me both offense and defense while keeping things simple and low cost. I don't have to chase individual stocks or worry about constant rebalancing. I can just let the ETFs do the heavy lifting while I stay focused on the big picture, building long-term wealth and making more income. There's no perfect portfolio, but this combination just feels right for me. It matches my risk tolerance, my financial goals, and my timeline. I'm excited to watch this mix of growth, income, and market coverage work together over time, and I'll continue to tweak and rebalance as needed. Whether you're just starting out or looking to fine-tune your strategy, combining VUG, SPLG, and SCHD might just give you the best of all worlds: growth, stability, and income in one all-powerful portfolio setup. Let me know if you are investing in any of these ETFs in the comment section down below. And if you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with the latest videos on the Financial Freedom Show. If you'd like your name featured at the end of every single video we publish, feel free to check out the membership link in the description. You can also have access to our videos a day before they're published, before anyone else can. And hope you guys enjoyed. Thanks for watching, and I'll see you in the next video.